Hi, my name is Pete Hahn, and thank you for watching this tutorial video. Be sure to visit www.hahn-tech.com for the full library of video tutorials. I hope this video increases your knowledge and helps you become more efficient with this topic, whether for home or work. Please support this channel by sharing these videos with your friends and colleagues.
Hi guys, welcome to the video. I'm doing a quick video here on market technicals. It's been a while since I published a video on this topic, but since we've just recently seen the headlines talking about the S&P in correction territory, which is 10% down from the 52-week highs, and then after reviewing the charts for myself, I thought, this is probably a good opportunity to share some of this with the audience to help you guys understand some of the aspects of a technical correction and some aspects about this particular correction that are unique. It's very rare for us to have this type of structure in the markets, and I'll explain that as we go along here. First, I want to go ahead and give you the genesis of this. You can see here from our YouTube channel, we go to playlists. And from playlist, you'll see technical analysis. Once you open technical analysis, then that will bring you over to this page right here. And you can see I've only got about 3 videos on there right now. I had published others, but I removed them over time because I felt that they were no longer relevant or helpful. But these were some introductory videos that explained the technical analysis in a way that was useful years later. And I'll give you an example here. You can see the screenshot here in the video of that spreadsheet. This is how I actually started back in 2014, I think. Maybe 2013 is when I published my first spreadsheet. And this is what I used to do, is I used to just keep track of it for myself on a spreadsheet. And I used to keep track of these. You can see these color-coded columns, so I could keep track of how far deep the correction went. And you have these colors here that indicate the severity of the correction. Obviously, 20%. We all know that 20% is how we reckon a bear market. Markets or indexes enter a bear market territory when they have declined 20% or more from their 52-week highs. And so this was just a handy little spreadsheet I created. And over time I refined the process and made it more automated, in which now you see I have an indicator that does most of that work for me, which is what you see on the chart. I'm going to take a little bit of time here just to explain to you what the indicator is plotting on the chart so you understand the computations and how everything is laid out. And then we're going to go back in history and show you why today's market structure is very unique. There's only been a handful or 2 times in the past when this particular structure has presented itself. Nothing ominous here. All right, this is not end of the world stuff. This is not market crash warning or anything like doom and gloom, nothing like that. It's just pure technical analysis. And so let me show you what's on the chart here. So for one, you see this bubble down here that shows the 10% correction, and those bubbles begin to plot as soon as the market makes a 10% correction. And there's some settings in here where I get to determine how many increments between each bubble or level. And this one in particular is set so that it goes down all the way to the 20% level. And you can see those levels are color coded as well. Let me go ahead and double click that again a little bit here. Now I want to show you then how that's computed. So you take a trend line tool and you draw it from approximately, okay, I'm not going to nail that 10% exactly, but you go ahead and mark a trend line from here to the high, okay, 52-week highs. And you can see that we have, that's a 9.99% correction. Now if I had drawn the trend line exactly at each level correctly, then it would show you 10%. That's how that level is being computed. So what we have here is we have been making new 52-week highs, and then we started to decline. And then once we declined 10% or more from that 52-week high, we can begin printing these levels. Now, what are these levels? You can see here some of these numbers you may look familiar to you. There are some Fibonacci levels in here. So let's go ahead and draw a Fibonacci tool on here, and we go from the 52-week high down to the low. You see this white line right here that started to pick up right at the 10% correction level. So go ahead and tag that right there. And you can see how these levels match up with the Fibonacci tool. So these are Fibonacci levels that my indicator is automatically plotting on the chart, and it helps me to understand where we're going to probably see resistance on the rallies to the upside and where we have to really push through before we can expect to make new all-time highs. So for instance, the ambush zone right here between the 50 and the 61.8% Fibonacci retracement. Okay, that's called the ambush zone. That is usually some very strong resistance there. And pay no attention to what you see right here, these candles that are entering into that Fibonacci ambush zone. That Fibonacci ambush zone didn't really exist at the time that those candles printed on the chart. Okay, these levels, okay, don't really exist until this point on the chart right here. So you would look from this point forward for those levels to be active. Okay, that's why they don't print back here. Okay, let's go ahead and remove that Fibonacci tool. Okay, they begin printing when they are relevant, okay, when they're active. So now let's go ahead and review this a little bit more. I intentionally left a lot of the data off the chart so that you couldn't see this unique structure that we have here. So let me go ahead and add some data to the chart so you can see here that what we have, okay, let me double click over here to reset that range, and I'll adjust this a little bit here. What we have here is you can see that we had a 52-week high and a correction from way back here. Okay, so if you go back here, okay, there we go. It's a lot of time, isn't it? So 2021, early 2022 is when we made the last 52-week high, and this is the all-time record high. And we began making a correction at this point here. And then you can see here that after that correction, we bounced and we held firm at the Fibonacci ambush zones. Then we made deeper cuts into that correction territory. Once again, those Fibonacci levels were active and effective at resisting price rises from that point. And then we can go ahead and move forward and examine how the rest of that played out. You can see another attempt to break into and through that ambush zone, and that failed. And you can see these levels update each time that the market made a new correction low. Then, in fact, this right here, this is bear market territory. If you look at that, that's a 20% correction here. So the S&P actually went below the 20% into bear market territory. And you can see all the times that it has struggled to try to get back up through these ambush zones. Okay, you see here and here and here and here. Well, what happens here? Okay, this right here is when the 52-week cycle is reset. Okay, so if you want to go ahead and measure that, if you go from this point back into the chart, you'll see that we have reset our 52-week high, and now we are beginning the process again. But let me show you how that works really quickly here so you understand exactly how that's being computed. What it's doing is it's looking back a total of 252 trading days, because there's approximately 250 trading days per year. So this is where it gets reset on this bar here. So if we drag this back over here and we make sure that that line is 252 bars in length, okay, and then set that right there. It's not exactly level, but really what's happening is it's picking up this high back here and it's looking back all the way here. All right, 252 bars. So 52 weeks. This is now a new 52-week high because it's looking back 52 weeks in the past to see if there's any higher highs in the history. Okay, so let's go ahead and take that off the charts so we can clear things up a little bit. Now you understand that we have here, and look at this unique structure. Look at this. So we have a former new all-time high right here, okay, right around 4,800. Then we have this correction, went to a bear market correction, and then we have not yet made new all-time record highs, okay? We made a new 52-week high here, okay? And if we scroll forward on the chart to present day, we see that we still have not eclipsed those previous all-time record highs. This is the part of the structure in this market that is unique. Yes, they're telling us that we're in a 10% market correction, but with the prices that they are right now, if we take the low, okay, from Friday, we're actually about 15% off the new all-time record highs. So it's not exactly 10% correction if you really take into account the new all-time record highs. Okay, so that's the part I wanted to explain to you. And now that you understand how to read the indicator, let's go ahead and take a look at some historical structures that are similar to this. And for this, I'm going to change the chart to a weekly time frame so that we're looking at 52 bars for a year instead of 252 daily bars. Okay, we're going to be looking at 52 weekly bars. That will allow us to look at the entire history of the S&P 500 a little bit more quickly and a lot easier. So what I've got is a few items that I want to show you, and I think the first step back we're going to take is to 2008. Okay, and I've got some notes on another monitor here to guide my process here, and I just want to go ahead and scroll back now in time. This is now a weekly chart, and you can see we've had several corrections in that time span. I'm just going to scroll through here, but you notice all of them have 52-week highs, okay, and new all-time record highs before we get the next correction. You see that the most common feature of the market structure is for it to correct, but also to make a new all-time record high, okay, before it makes another correction. Okay, see, here's another one. We made a correction, we made a new all-time record high before a new correction appeared. Okay, so we're going to keep scrolling back here, and this is in 2010, actually. 2010, you can see we have an instance just like we have now, in which there is a new all-time record high way back here. We didn't eclipse that, okay, and instead we entered a new 52-week high cycle that was short of the new all-time record highs, and then started making a correction. So you can see this is kind of a rare pattern. Now, it's not all doom and gloom. Like I said, it's not doom and gloom, but I want you to understand this, okay? And you can go ahead and go back and look at this on your own charts. I'm just going to spot these and identify them here for you. This right here is the 2008 financial crisis, if you want to call it that. You can see the correction was very, very deep. Let's go ahead and mark that on the charts. We'll go ahead and draw a trend line from here to the 52-week all-time highs. And you can see that that went down about 57%. So let's go ahead and take a look at a few more of these. The next one, we're going to go back to the 70s. So we've got a long way to go here. I'm just going to scroll through here carefully. You can see there is a new 52-week high after a correction. Okay, you see that right there. But you don't see any more corrections until we make a new all-time record high over here. Okay, 1580. And so let's go ahead and go back here and look at these. You see these corrections. Again, the normal pattern, or I should say maybe not the normal pattern, normal's the wrong word to use, but the more consistent or the more frequent occurrence is that we make new all-time record highs before a new market correction. So you can see we've got lots of corrections that have taken place in the historical record. And by the way, here's the 1987 crash. If you want to put that in historical perspective right there. Let's see, we'll go ahead and keep scrolling back here until we get to the 70s. We're in the early 80s now. Again, here it is. You see that this is the typical pattern, is that after a market correction, we make a new 52-week high before the next market correction. That is the rule rather than the exception. So let's keep going back here, and here we go. Okay, so here it is. It's very subtle, but if you look at it here, this is in 1978. Here's a new all-time record high, and before we were able to break that all-time record high, okay, of about 1008, we entered into a new cycle of new 52-week highs, followed by another correction. So you can see it didn't spell doom and gloom. It wasn't the end of the world or anything like that. But again, it's a very unique structure, okay? And that's what we've got going on right now, and why I'm taking the time to review these charts. So here you've got another instance of this, okay? So right here, you've got from 1975, you had a new all-time record high here, and then we made new 52-week highs here. We couldn't get back up to those new record highs before the next correction cycle began, and then there we are. And so it took some time for us to go ahead and break those all-time highs from 1975. Let's go ahead and shrink that down and take a look at that and see how long did it take actually. Okay, so there we go. So we put the marker right here. So from let's just go ahead and put this right here. This is the high, okay, 1973, January 1973, and we didn't break that high until July of 1980. Okay, so that is from the historical record. We're just looking at what has happened in the past when we fail to make a new all-time high before we start making a new 52-week correction. So let's keep going back here in the past. Again, we got another example of this, 1970 into 1971. Again, we made a new 52-week high cycle and didn't eclipse those previous highs before a new correction hit. And let's keep going back here. And again, look at all these structures. You can see quite clearly that markets tend to more frequently make new all-time highs before the next correction cycle. That is just the normal behavior of the market, or I should say the more frequent behavior of the market. Here's 1947. So we made an all-time high here in 1947, and we didn't eclipse that until 1950. September 1950. Now I suspect there's something else here in the background on the chart here, so let me go ahead and shrink things up a little bit, put some more data on the chart here because we're coming up on the big one. Let's see. So here we go. We got 1936. Now we're at 1936. You see this high, and you can see that big high right here at 1867, and it takes until 1946. Okay, so almost 10 years before we eclipse that previous all-time high. And we just go ahead and take this all the way back to the big crash, and you can see this one here. Let's just put it on here. I'm sure there are people out in the audience that say, oh, we already know this, we already know the number. Well, there it is. It's 84.86% decline in the big one, at the big crash. And so just wanted to let you guys see that in action and understand the unique structure of our market today. And let's go ahead and take us back to the current time frame. We'll look at this here in context, okay, and understand that we are in quite a unique situation here in that we have not made new all-time record highs before we've entered another correction. So looking at the historical record, you could make your own assumptions, but I just wanted to bring this to light to help you guys with your analysis and help you understand the structure of the markets, and hope this helps. Please leave some comments below, and please be sure to share this with your other trading buddies and trading partners, and let me know if this is useful or valuable to you in any way. All right, that's all I've got for you guys. Take care.